Welcome back, and it is time for the Word on Wall Street. Top investors watching your money. Joining me right now is former Gartman letter editor Dennis Gartman and Lebenthal Global Advisors President and Chief Investment Officer Dominick Tavella. Gentlemen, great to see you. Thanks very much. What a week we have seen. Want to get your take on all of the happenings as we look at this market this morning. Futures are mixed. We are expecting a decline in the Dow Industrials at the start of trading. It's down 91 right now on futures. S&P is down 4.5, but the Nasdaq's trying to trade up. It's up about 7.25. Today is the FDIC's deadline for banks to bid on Silicon Valley Bank and Signature Bank, as 11 banks have rescued First Republic with a $30 billion deposit yesterday. JP Morgan Chase, Citigroup, Bank of America, and Wells Fargo all contributing $5 billion to that rescue. And in a joint statement, the bank said, in part, quote, "This action by America's largest banks reflect their confidence in First Republic and in banks of all sizes." We're looking ahead to the March Federal Reserve meeting next week. That meeting, Tuesday and Wednesday, expected to see a rate hike of 25 basis points, Dennis. But, of course, the conversation has changed with all of this bank failure conversation. Your thoughts on what the Fed does next week and how it impacts markets?
I think they have no choice but to move it 25 basis points for consistency's sake. If they went to 0, the question would be, what do they know that we don't know? If they went 50, the question would be, what do they know that we don't know? The fact is they've set a 25 basis point increase. I think it's incumbent upon them to, just for consistency's sake, to go 25. I think they'll go 25 this week. I think they'll go 25 in 6 weeks from now. And I think they'll go 25 again before early summer. And then we probably will have reached the terminal rate of Fed funds and probably will be done for a long period of time going forward. But 25 basis points has to be the announcement on Tuesday. We'll listen to what on Wednesday. We'll listen to what Mr. Powell has to say with bated breath. It's probably one of the more important press conferences of the era. So that's the big question. What will he have to say during the press conference?
Are you feeling better about the macro story in the banking sector with this $30 billion of deposit injection from the major banks, Dennis?
You can't feel worse. I think you have to feel a good deal better. The fact that they stepped up in total across the board, the 25 largest banks across the country putting $30 billion in, you had to be impressed by that fact. But do I think that this is the end of the circumstances prevailing in the banking system? No, I think there are more. As I've always said, there's never just one cockroach, and there's probably going to be more coming along. That's what I fear. But they made a good decision. I think it was the right decision. I'm glad they made that action or took that action.
And Dominick, we're wondering what this means for the central bank of the world central banks and their plans, because now you've got a clear question. Do I continue fighting inflation the way that I've been on track to raise interest rates, to slow the economy and stamp out inflation, or do I now prioritize financial stability and stop the rate hikes? People were surprised yesterday when the ECB raised rates 50 basis points. Now Goldman Sachs is lowering its expectations for the ECB's next meeting, the May rate hike. They say it's going to be 25 basis points, not 50, after the central bank raised rates yesterday by 50 basis points. Dominick, how do you see this new debate or sort of fork in the road for the central banks of the world on whether to go for inflation-reducing acts like higher rates or financial stability and taking to the sidelines, no action?
Yeah, so we got our answer yesterday. Lazard, clearly they raised interest rates to 50 basis points that you spoke about, Maria, and they're dealing with 8.5% inflation there versus our 6% here. They got started much later than we did in their rate hiking policy and inflation fighting policy. So they're behind the curve, at least compared to us. So they clearly prioritize fighting inflation as opposed to financial stability in the markets. And they did say they will support the banking system and the financial system. But at this point in the game, they're going to keep raising rates until something does break. And we obviously are starting to see the cracks in the system.
So how do you want to invest right now then, Dominick?
Well, we have to really be honest with ourselves and look at this picture and say, I don't particularly think it's doom and gloom. On the other hand, higher rates mean banks are going to be lending less. They're going to be a lot more stringent with their loans, a lot more disciplined with their loans, and they're going to do it at a higher rate. That slows economic activity. Consumers, this banking crisis, we're getting phone calls daily, Maria. Hey, is my money safe? Is my money safe? Kind of going back to what happened in '08. We don't have that kind of crisis on the table. That's not what we're dealing with. But when the consumer is afraid, they stop spending money. And then we got to look at the whole corporate community out there. How many institutions, how many companies literally don't have enough money today, don't have the profits today to pay the debt on their balance sheet? Floating rate loans out there, just like home adjustable loans that have gone and will go higher. Corporate profits are really going to be affected by all this.
Well, that's why Stephanie Pomboy noted that there's $1 trillion in debt sitting on corporate balance sheets right now that will roll over this year. So depending on the company you're talking about, will they be able to pay the higher rate that comes with that rollover? We're going to be watching. Dennis Gartman, Dominick Tavella, great to see you both. Thank you, gentlemen. Have a good weekend. We will take a short break when we come back.